So thank you, George and Ryan, for coming on. And I'm so happy to have you guys here. So George is an accountant, Ryan is a lawyer. So let's start with a little bit of intro. So if Ryan, can you tell us a little bit about yourself? We'll start with you.
Sure. So I'm as Diana mentioned, a lawyer. I have my own firm, Carson Law Office. It's centrally located in the Golden Horseshoe area in Burlington. We work a lot with real estate investors, corporate, commercial businesses, wills and estate planning, estate administration. We do intellectual property as well, patents and trademarks, copyright work, and we're just launching a new branch of paralegal work, which will be landlord-tenant, small claims, provincial offenses, tax office, tax court stuff. So that's kind of in a very high level nutshell, who the firm is, and so I'm the founder and president for the firm. We've got a group of 4 lawyers, 1 retired counsel, staff of about 20. And, as I said before, we do focus a lot with real estate investors. We work a lot with George and his partner, Peter, through the BDO. They've been great partners for us over the years. And George will, not stealing his thunder, he's definitely the best dressed I know. And they work with the BDO, with the Center of Excellence for Real Estate investors and agents. And he'll talk a little bit more about that, I'm sure. But everybody's very familiar with what you guys are trying to do. And I think that gives us a bit of an edge for you as lawyers and accountants. Sometimes you go to speak to a lawyer, even a real estate lawyer, and they're not really investors and or understanding what investors are trying to do, what kind of the chatter is all about, what types of deals are being structured or trying to be structured. And so we're going to all the meetings just like you guys, and hearing and seeing what people are talking about. And so we're fairly intimately in line with what you're all trying to do as investors. So I think that helps us relate to you, and it helps us get the job done for you. So that's me.
100%. Thank you so much. And it's so true. It's very good that, you guys are involved in seeing what's going on and staying up to date. And so, George, would you like to tell us a little bit about yourself?
Sure. I guess I usually start with the idea that I am a tax accountant. I'm a partner at BDO. And as Ryan indicated, I guess in theory, my territory, if you will, is I try and help out my other partners and my clients in what we call Central Canada. But that being said, I've got a lot of clients in BC and Alberta and Nova Scotia and Western Europe, Southeast Asia, etc. So I'm not really sure what the Central Canada part is about, but it is what it is. And yes, certainly part of the Center of Excellence for Realtors that we have. The predominant part of my practice is essentially that real estate investor or developer that is in various stages of growth, and whether they're just starting off or they're getting ready to hand off the portfolio to the next generation. We love working with everybody in between, if you will, and whether smaller or larger. Again, I think my focus is predominantly the small, medium-sized investors, whereas I have other partners across the country that may work more with the multi-gazillionaires and things of that nature. That's not specifically my cup of tea. I think the majority of clients like coming to us in that, as Ryan referenced as well, it goes far beyond a technical expertise. The practical part to it, and being able to, not that I can in the slightest do what Ryan does, but I have a little bit of understanding of some components. I have a little bit of understanding from a finance perspective, an insurance perspective. The fact that we just invest in quite, I don't want to say quite a number of properties, but it's beyond a handful of properties. It gives us some experience with that, and then the experience in dealing predominantly with clients that are doing the same. There's a lot of knowledge there, of course, that's picked up, and it's, I would suggest, a lot cheaper for someone to talk to Ryan or myself, learn about our mistakes, the mistakes we've seen with clients, or the good things that we've done or have seen with clients. Far, far, far cheaper to do it that way as compared to try and do everything yourselves. Not that Ryan or I know everything. I won't pretend that, although we got a pretty good corner on the market, I like to think, in our respective areas. But it is something that we pride ourselves in, that ability to go technical and practical. That's where our value is going to come in. And not that somebody can't teach us something. We're, as Ryan said, we're going out to all these meetings and things as well. We're trying to learn, but we're not going to start off ground zero, if you will. For the most part, we'll be doing the teaching, but I don't want to pretend that I don't get taught occasionally either. And that's exciting.
100% makes sense. And always, because things are always evolving, people are coming up with new strategies or new ways of doing things. So not anyone of us, anyone, I feel like, even I feel like real estate, even if investors are in real estate forever, even as investors, we're always learning a lot because things always evolve, things are always changing. So I completely agree. But it's always good that, you know, having that upper step where it's like you have someone that's in it, that's doing it also. So getting to that, let's start with the first question. And the first question, we'll just make it really easy, really basic, and just tell us like, what is real estate planning? Like, why is that important? And I guess let's start with first George, if you can start answering, and then we'll go to Ryan.
Sure. So I don't know. I don't know exactly what the definition of real estate planning is. I thought that was an interesting question, but I think my component, because I think in my envisionment, if you will, it's going to encompass a variety of different areas. And it starts perhaps just with the basic investment component to that. And then you start socking into that, the tax side, the accounting, the management information, the legal, the insurance, this, that, and the other thing. What's going on from a family perspective? What else do I have going on in my life, business? Where am I trying to go? And I like to, of course, from my bias, bring in the heavy on the tax side component. I have a stronger knowledge than probably most on the accounting and management information side, although, and as Ryan referenced, I like to kind of put that on my partner's Peter's desk more so than my desk, but it's not that I'm oblivious to it. And I think it's more of a recognition that, again, in my case, on the tax side, tax does not necessarily rule the roost. It's going to be one of the components that an investor should be considering, but it really does need to be dovetailing into the other areas that are important to our clients. And where I think it really comes into play is to say, I see far too many people that are really, really focused on what are the tax implications today, maybe even next year. But as a real estate investor, to me, that's astonishing because most of us are going to be medium and long-term looking. So why would I care to a degree what the taxes are today? Not that I want to get blown away with taxes, of course, but the vast majority of people that I end up speaking with, they've read this, heard that, maybe set up in a particular way that is very, very short-sighted. And so, okay, let's see how we can do that. And it doesn't mean we fix it all at once. And in many cases, somebody's been perfectly set up initially, but now they've just outgrown whatever it was where they started off, and now they're moving to that next stage. And so to me, the planning component comes in. Let's try not to be reactive about this, but let's think where we're heading, what our exit strategies are, what we're doing with our family or charities, and now we can start to dovetail this and make sure that we're not doing something that Ryan and his team don't like, or where there are going to be contrasts. Let's identify those. So get them on the table, talk about the pros and cons, and now Ryan and I can do that in a very, very educational format, if you will, and clients can, and Ryan and I will make recommendations. Again, we're not going to, I'm not going to say you should always be thinking tax first. And quite honestly, I prefer to think on the legal side first, because that's one of my biases. I want to protect myself, but I don't want to give away the farm either. I'll pause and let Ryan take over.
Actually, and I want to add maybe a little bit more to that question for Ryan. So the same question, but also I guess with adding that when you're speaking about it, is it more just related to corporate, or is it also real estate without the corporate sense?
Well, I mean, you know, if I understand the question and can expand on what George is saying, I mean, when clients come to me and they kind of say, you know, I'm a real estate investor, I've been doing it for a little bit, or I'm just getting started, or I've been doing it for 10 years, and they're kind of like, this is what I have, this is where I want to go. I mean, that I'm always suggesting first and foremost to people, okay, who's on your team? Like, who's your accountant? Who's your financial advisor? Who's your mortgage rep? Who's your insurance? Hopefully, obviously, if they're talking with me, we're their lawyer. Because, I mean, I like to know who everybody is so we can have that conversation with everybody, so we can get everybody kind of in sync with everybody's different points of view. Because all of us as professionals will have a different point of view on your plan. And that's not to say that they'll be going in different directions, but you know, an insurance person is hired for the expertise of giving you the most sound insurance advice and protection for, you know, tomorrow, a year from now, 5 years, 10 years plus, right? And so the same thing is true for everybody else on the team. So I like to know who the team is. That's the nice part about George and I working together, is it gives you two pretty good pillars right off the bat that are pretty in sync, and we know how each other's internal processes work, so we can be efficient that way, or you know, we know enough about each other's internal workings so we can be efficient that way. And we've kind of gotten in a bit of a groove where we sort of know, okay, we've got some pretty, I don't want to call them precedents, but we sort of have groups of strategies kind of set up for different types of investors and their goals, right? So I think it's really important when you're talking about, you know, setting up your real estate plan. It's a business plan, right? I mean, you're either becoming a real estate investor or are a real estate investor because you want to do something with it. Usually that's in some aspect making some money. It might not be your primary goal, but it's probably a goal. And you want to make money that's either going to be a primary stream of income, or maybe it's a secondary stream, maybe it's tertiary stream. But the bottom line is you want to have the players on your team so you can all communicate together. They can understand where you want to be today, a year, 5, 10 plus years from now, and structure the plan accordingly, right? It's funny that George indicated he kind of likes the conversation with the lawyer first, maybe because I think that's his conservative nature of, I want to make sure myself and my clients are protected. Because I typically say the opposite of, hey, have we talked to your accountant yet? Because I really need to know what they would like set up, or what conversations have occurred about how do we make most efficient use of tax rules and planning, because that will dictate.
Sure. Maybe I can clarify there, is to say, I still think probably in most cases that you're right, it's easier to talk to the accountant first, but more my point was that where we're talking about structuring, whether we're doing things personally, corporate, family, trust, this, that, or the other thing,
Yeah.
I put a heavy dose of the legal side on that, was where I was trying to go with that.
Yeah, absolutely. And I mean, and that's where working together just really helps in your plan, right? I mean, everybody talks about having a plan, and it's not just a plan, as George mentioned, for tomorrow or even a year from now, because you're probably, if you're venturing into these waters of being real estate investors, or already, you know, swimming in the deep end, at the end of the day, you need to have a plan. And it's a business plan, just like anybody else. Just like George has a business plan for himself with his accounting practice, I have a business plan for my personal practice and for the business overall. And I think the other point that's key to hit on, to echo what George said, you have to review that plan, right? Because if you're already an investor, maybe what you started with 5 years ago, you've outgrown, or there's been changes in rules and laws and regulations. There's definitely been changes in corporate and tax changes in the last, you know, 4 or 5 years. And so, you know, I'll give one example: the 3-tier structure that you probably have read about if you've been following different real estate networking groups, you know, that was like the go-to, like, hey, I heard about this, you know, 3-tier structure, you know, set me up. What do we do? And that might not be the best way to go anymore, just on the basis of changes in corporate tax laws and retained earnings and so forth and so forth. So, I mean, it's really important, I think, you know, not to belabor a point, get a really good team, because with a really good team and everybody working kind of in the same direction, which is to accomplish your short, medium, long-term goals, you can put together a really, really good real estate plan. And that's really a business plan.
Yeah, it's a really good point. And basically what you both are getting at is like having the lines of communication is so important with your whole team. Yeah, that's a really good point. And so even if you don't have a corporation, then you just want to make sure that everyone is aware of what's going on, so that, you know, like exactly what you're saying, right? That whatever the business plan is, like we're all, like everyone's on the same page and know what the goals are.
Absolutely.
That's really, yeah, that's a very good point. So does anyone have any questions before we get on to the next? I felt like Hamid, I don't know if you want to say your question. Everybody's paying attention right now.
Sorry, you just called me. My kid's shouting in the back.
Oh, I was saying, do you want to ask your question?
Yeah. So I'm actually based out of the U.S. I am Canadian. I'm in the U.S. on a visa. Now, what I'm setting up a syndication business in the U.S. I'm trying to figure out the tax structure there for me as a Canadian. So what I've come up with so far is setting up an LC, which is owned by a limited partnership, and then just leave it under my name there and not have any corporation in Canada. Does that make sense? Because I'd be paying out dividends to myself there, or is it better to set up a corporation here in Canada as well?
So my first comment would be I would have you talk with one of my U.S. tax partners. So I won't pretend to be a U.S. tax expert. So we have, well, it would probably be John essentially that you were chatting with. But in saying that as a real general comment, the structures that Ryan just referenced, this idea of the 3-tier structure in Canada and why that's outdated. The structure you've described is also one of the older structures in the US, and we're not using it nearly as frequently any longer because of some of the rules of the current government that were put into place. So it is something to consider, whether that I'm not saying that it's wrong, because again, I can't emphasize enough, I'm not a US tax expert. We do have a lot of clients investing it, so I get to observe what that advice looks like in many cases, but I won't pretend to know all the nuances as to go with method A, B, or C, for example. But what you've described is something that I saw a lot more prior to Trump making the changes on the tax side for the US. So I'd be a little cautious of that, but I'm not saying that's wrong.
No, absolutely. If you can maybe in the chat put your contacts information so I can reach out to him then.
Sure. Or send me an email and just give me a quick reminder, and then I can introduce you to John. And,
so if you can share your contact information, I guess.
Yeah, and I would echo the same as George. I mean, lawyers are licensed by province or state. So I only hold a license to provide real estate advice in the province of Ontario. So you would be, I mean, best served to, you know, talk to George's colleague who has that ability to provide advice on US tax. And then I would assume George's colleague probably has a direct or indirect connection to some US attorneys that have the ability to provide advice and or give advice with cross-border issues and so forth. But unfortunately, that wouldn't be something I could give advice on.
Okay, no worries. Thank you.
You're welcome.
Okay, so then now moving on to our next question. In your guys' experience, I will start with Ryan first. So but in both your experiences, are there any things that you see that are kind of commonalities when you're thinking about when to start planning? You do real estate planning?
I guess one of the common things that I see is people planning maybe a bit late in the game, because people are, you know, very excited about real estate investing, and so they're immediately looking at, you know, properties, right? They're looking at opportunities and investments, and then it's kind of like once you're kind of knee deep or shoulder deep in some dealings, then you kind of have a reflection moment. The light bulb comes on. You're like, oh yeah, I better go talk to, you know, the lawyer or the accountant, you know, maybe my mortgage advisor. Lots of people seem to be doing their first deals or already have done their first deals, and then they kind of have that light bulb moment. So if it's possible, if we've got a lot of people that are listening or do listen to this recording at a later date, that are more in the beginning stage, I would say do something a bit different and do your plan and meet your team and get structured right away at the beginning. And I'll give you an example of that. We have some clients, you know, many clients actually, who have come to us. They've done a bunch of deals already, and they you know, there wasn't a lot of planning behind the overall course of their real estate investing, other than the details of the deal, right, or the deals. So what needed to occur to get the deal done is what was planned, as opposed to, yes, that's part A, but part B is, how does A fit into my overall strategy 1 year, 5 years, 10 years plus? And so the best example I can give is people get their first couple deals done, but they either own it personally or in a structured vehicle that is not what they want to use medium and long term. And then the issue you get with that is, okay, how do we get it out of that structure, or can we get it out of that ownership structure without paying, for example, land transfer tax again, or having a capital gains ding, or, you know, whatever the case is, right? So I've met lots of client investors, which is great, and I'm really happy for them that they've been very busy and very successful amassing up properties, whether it's RTOs, BRRRRs, long-term rentals, flips, you know, whatever the case may be. But they didn't do that initial full business plan. And so a lot of the times they own the properties personally because that was the easiest way to get the mortgages or whatever the case is. And then really the best long-term strategy is some sort of family trust corporate structure. And then it's like, okay, that's great. I'll use that going forward for, you know, all my properties that I do, or all my investments I do. But what do I do about these other 10 I have, or these other 5, or these other 20? And you know, that's a commonality that I see a lot, is people kind of bring the deep planning and strategizing after they kind of done a couple deals, which is, it's never too late to get started on it. So don't get me wrong. Don't be discouraged by what I'm saying. I guess I'm just saying maybe change that commonality a little bit and start the big plan earlier if you can.
Totally makes sense. Yeah. And George, do you have any additional comments?
Piggybacking on that, and I certainly agree with what Ryan said, but the sooner we can kind of talk to someone, the easier it is for us to create that picture, if you will, without having to not necessarily start over, but it's a lot cheaper to do it right the first time, thinking of where we want to be as compared to where we are today. And the other aspect I would toss in there is to say, I think it's critical, even once somebody's been set up, if you will, that they, on an annual basis, they sit down virtually with for an hour with Ryan and myself. It can be separate meetings, but let us keep involved in terms of what's going on, because the rules are changing. The family situations are changing. Businesses situations are changing. Objectives are changing. So we may not be in the quote unquote correct structure. And it's usually not that we have to do a major overhaul, but at times, yes, we need to tweak something. And perhaps we're going to be able to as well. Oh, yeah, now that I see that you're going off in a slightly different direction over here, there's, by the way, did you know there's this new tax rule or a new legal rule or a finance or whatever it may be that came about? Maybe we can apply this in your case. And so having that constant communication, if you will, and I don't mean that it needs to be on a daily basis by any means, but at least taking an hour once a year to go through that, even if everything's quote unquote normal, steady, etc., other things are happening. And that's what we would like to be able to address as well. That's where I think, for example, somebody coming in and getting a set of financial statements, tax returns done, sure, we can do them. Quite honestly, most accounting firms should be able to do them reasonably well. The real value comes in talking in terms of how do these rules, or heaven forbid, some knowledge of rules that are coming down the pipe, and not that we have an inside access, I don't want to ever pretend that, but at times in the industry we hear more things, if you will, so that there's more of an indicator. And maybe that's right now, for example, there's a major tax planning opportunity we perceive. It doesn't mean that we know with 100% certainty this change is going to occur. However, we're going gangbusters right now because it all makes sense, and it's been disclosed in some newspapers or media, I should say. So why aren't we taking advantage of that? So somebody's kind of waiting to see what last year's rules are in some cases. Well, that'll be too late. And again, I think that's the value your team provides. It's not the compliance aspect. It's not setting up a corporation. It's not, well, setting up a family trust a little bit more complex. So there is value to that part to it. It's not doing a set of statements or tax return. It's what's behind it. What can we do with that now? That's where Ryan's team and my team are going to really show their value.
Makes sense, yeah. And to kind of continue with the topic, because you made a point about, you know, the medium to long-term strategy. Are there questions that we should be asking ourselves, or specific areas in our lives that we should be paying attention to ask the questions? And by that I mean, like, you know, if we have a family, or if we're single, or like what should we be paying attention to in our lives that we should make sure to mention to you guys, so we make sure that we are talking about the right things that are good for us. So I'll let George start with what questions we should ask ourselves or kind of keep in mind.
To me, it's focusing on what's going on in your life and where do you want to be. And it's actually not necessarily anything very, very technical at all. I want to know, what are you trying to accomplish? As we've been talking 5, 10, 20 intergenerationally, what's that legacy look like for you? What's important to you? And it's probably not just real estate. There's going to be potentially other aspects, and whether those are charitable, whether those are more spiritual based, whether those are, I would love to have a car shop, or I'd love to have a ice cream factory, or I want the ice cream dispenser. Or again, my job, Ryan's job, is not to tell somebody what they want to do. Our job is to help them bring that to fruition and to show them, I think this might be a way of more easily doing it. Have you considered doing something like this? And maybe on a more direct real estate side, somebody is looking for syndication. Maybe somebody is looking to grow more significantly in a particular area, whether that's geographic, type of property, exit strategies, things of that nature. Wonderful. Let's try and put together a plan where we can help you get there with changing as few things as possible, I guess, or at least making sure we don't have any extra costs involved in that process. But it's not necessarily trying, in my mind, to figure out all the things you should or shouldn't talk to the lawyer or the accountant about. It's more of just chat, just as we're doing right now, and having that conversation. I keep using an example, and it goes back now a number of years. However, I was chatting with one of my clients, and we were just talking about the kids in hockey, actually. And through the conversation, it came about that I realized, and never thought to ask before, she had a third car. We've been writing off 2 cars, never thought to ask if there was a third. I mean, our checklists and whatnot always ask for automobile expenses, et cetera, et cetera. But it wasn't something that she even thought about until after she had made this comment, because I knew her well enough. I knew what vehicle she was driving, and or sorry, I thought I knew which vehicle she was driving, and here it was. There was like another $100,000 of expenses that we could take, and so it had nothing to do with accounting or legal work. It was getting to know our client, and that's clearly not done on day one. That takes time, but not that I'm promising that for everybody. I don't mean it that way, but it's more just a real silly example, but it was meaningful. And so to know what people are trying to do, that allows us to start figuring out, okay, how best can we get there, as I said, and make sure there's as few impediments or obstacles as possible there.
Yeah, it makes sense, especially it's kind of like what you're saying, like it's probably also to build that relationship with your team and actually get to know your team and vice versa, because when it's business, you may not actually get to, if everyone's like leaving everything to business, you may not get to know things in a personal level that could impact. So Ryan,
I don't know what's important necessarily. I
exactly.
don't know, and Ryan won't know, even when we're doing more estate and succession planning. We may be trying to do something that we think is relatively standard, and that's not applicable to you. And certainly we've run into cases where we definitely went off the beaten path. Not that it was wrong, it was just different.
Mm-hmm. Makes
Mhm.
sense. So Ryan, would you like to add on to that?
Yeah, I mean, I wouldn't add that much more other than to say, yeah, I mean, we do have our checklists. I mean, as lawyers and accountants, checklists are kind of something that we live and die by. It's so that we don't, we've done it enough times to know what definitely should be there, and then we, further have added to those checklists because we've learned throughout the years different things to potentially make sure we ask that maybe we haven't asked previously, or as things change and evolve, you want to make sure you add or subtract to those lists. But as George said, it's the intangible of just continuously getting to know your clients, getting to know where they want to go, where they've been, where they are right now. I mean, one of the plugs I always I give our team here is, we're not just there to do your real estate deal, but like we can structure the corporate or family trust component. So you don't have to be like, oh, okay, I'll use Ryan to do the real estate deal. Oh, now I need somebody different to do the corporate and the family trust or whatever that structure looks like. Oh yeah, I really need to do some estate planning too. Well, good, we can do that too, right? So we really kind of wrapped we try to wrap ourselves around you from the legal planning side of it so that you don't have to worry about going anywhere else. And then it becomes easier for us to, in the short and long term, get to know you a little bit better, which is where the more you get to know your professional service providers and the more they get to know you, the more likely you are to have more value, right, out of the relationships, like George mentioned in his example. I mean, knowing somebody has additional, vehicles to write off from further expenses, you only get to know that as you get to know your people better, because people only know what to tell you on what you ask them typically. And sometimes we only know what to ask you based on, our checklist. So intangibility of getting to know one another better and better and better is crucial, because you understand then where people want to go.
I think also a great question for people to ask, and it's not specifically to themselves, but to Ryan and I, is what would you do? And so kind of peeling away all the technical answers to things, because at times there's I don't want to say a difficult decision, but a complex decision, or certainly one that's not painfully obvious. And then more importantly, beyond what would you do, why would you do that? So then you can kind of get into our heads, what are our biases? And I'm happy to tell somebody what I would do. I would never tell somebody you should invest in property A versus B or stock A versus B, but I would tell you what George would do. And I would certainly tell you why I would do it. And that way, if George is if George is in love with a particular type of geography or again a strategy or whatever, okay, now you can kind of balance that to say, okay, I don't share George's view of that, and then you can also ask George, okay, George, if you didn't feel that way, but instead you felt like this, now how would your answer change? And so now you're starting to get into our heads, and it also allows you to kind of look at the pros and cons. And I think a lot of investors, they get overwhelmed with information, and whether it's on the internet, going to a workshop, doing this, doing that, and you hear all sorts of things, and they may not even be of the right country in terms of what those rules are. But then I think it provides a lot of I was going to use the term satisfaction, comfort, that's a better word, where an investor, for example, can come to me and say, okay, I heard this and this and this. And if I can reconcile that understanding that they have, show them what in many cases, they've heard part of it and it's just not in the correct context. Now let me put that into context, or let me tell you why I disagree with that opinion. And now all of a sudden, the client's in the driver's seat making decisions based on real information as compared to segments of information. And I think the better advisors, such as Ryan and myself, are certainly capable of doing that.
Yeah, it makes sense. And I just wanted to actually have a follow-up to your question, Ryan, or if you have any examples of your checklist that you can tell us.
In which aspect, like the real estate, or like so I mean, we have checklists for almost any type of file that we would open, right? So I mean, you know, we've got a checklist specifically for, you know, corporate structure and incorporations, so that we make sure we ask all the technical questions of, you know, who are going to be officers, directors, shareholders, what kind of share structure will there be, the rights to the different shares. I mean, there's those kinds of checklists, but then there's also checklists of just like, you know, what are you doing right now? What do you want to try to accomplish? You know, where do you want to go? What's important to you? You know, as George mentioned, you know, you might be using real estate investing as primary income. You know, you're done with, you know, working for somebody else, or whatever the case is. You want to work for yourself, and you want to set your own rules, and you want to do it your way. And so, you know, it's a primary vehicle of income for you. You know, that carries with it probably different strategies and ideas and goals. And then on the flip side, you know, if somebody said to me in that kind of, you know, process of going through a checklist, you know, we don't actually need real estate investment to live or anything like that. We have salary jobs, or, you know, my husband or wife has a salary job that supports the whole family. This is something for us to do that will allow us to create, you know, estate legacy potentially for intergenerations of hopefully our families to come. Or, you know, it's really important to us. It means a lot to make sure we're donating to a couple different charities, because, you know, just using a client example, one client, they do use a lot of their investments in part for charity donations to a couple hospitals, because they had a child that was quite sick when they were young. And so it means a lot to them to continuously support those hospitals and treatment centers through financial means. So for other families that are going through the same thing, right? So, you know, when you start to ask those questions on not just the transactional checklist, but I guess the get to know your client and the personal checklist, it helps us, again, put our arms around you a little bit better, and hopefully give you a bit more value other than just closing transactions, but getting to know you and then helping you with your business plan and flush out and evolve your business plan over years to come.
Yeah,
if that makes sense.
Yeah, that makes sense. I'll give a minute to see, does anyone have any questions that they would like to ask? Going once. Going twice. I feel like this is a very new topic for people, especially that a lot of us are new investors, where it's like, you know, something that we're not talking about enough or thinking about, because exactly what you guys said, like people usually are much further along in the path and then think like, oh, maybe I should start thinking about that.
Yeah, but even to that point, like, I guess I mean, you're raising a good point. Even if you're brand new and you haven't done any deals and you're on this call, or you're watching this video at a later date, the idea, and it's so fundamental that we sometimes take the most obvious things for granted, right? Getting a solid team to support you, to help you focus on what you do, which is hopefully make sound real estate investment decisions. It means you don't have to worry about doing like your mortgage. You don't have to worry about your accounting, your bookkeeping, your legal stuff, your closing transactions, you know, your insurance. If you have that team right at the beginning that you're really comfortable with, and you take the time to, you know, introduce all of them if they don't know each other, and everybody tries to get on the same kind of path with you, and really take time to at least do an original business plan. And as George and I have alluded to, that plan is going to change. It is going to evolve, because that's the only constant in life, is change. You know, if you do that at the beginning, it's going to better serve you 20 years from now than the person who just is like, well, I'm already 10 properties in, or 10 deals in. It's pointless for me now. You know, it's never going to be pointless. You can always start to do that plan. If it means, you know, those 10 properties kind of get, you know, compartmentalized into their own little group, because we're just like, okay, they'll have an end game individually for each of them, but let's get everything else moving forward on this plan, right? It's that plan that I think will create a huge sense of value and benefit to you. And it's never too late for that, for sure.
Sorry, maybe an example to that would be where, a couple of years ago now, had a client pop in, and they thought, maybe it's around about the time I should be starting to do some estate planning. And he and his wife were in their mid 80s at this point in the game, and had a variety of personally owned properties. And oddly enough, they had a family trust, although I think it was done incorrectly, but whatever. And a corporation which owns some, he was an executive at a well-known public company. And so he had a variety of shares in that corporation. And so despite the fact that he undeniably was going to end up paying probably, as a real rough number, say an extra $3 million in taxes, because he didn't talk to us a number of years ago. At least we're not adding to that anymore. So he's actually, I think, a relatively conservative example, probably now saving somewhere between $100,000 and $200,000 a year, just because at least he came in and started talking. So I could have saved him a lot more, but saving $100,000 or $200,000 a year isn't bad either. And it was beyond real estate. So he had quite a, or he and his wife have quite a stock portfolio and what have you. But again, just having those conversations, most people aren't going to start anywhere near there. But to Ryan's point, ideally, before you're in your mid 80s, you've started chatting with us so that we can, not that they have lived a bad life either. It's just that $3 million or so. Imagine what that could have done for the next generation, charities, the church, the Cancer Society, again, whatever it is that's important to you. It was probably better in their hands than the government's.
Yeah.
Yeah. So let's go, George. As an accountant on the accountant side, obviously, I mean, you are, but just making sure that you like it's in your side, is that when you're thinking of structures, for example, like that three-tier structure in a corporation, or let's say just one corporation, or the family trust, or whatever strategies, other, you know, not as strategies, but approaches that there are to take.
Yes.
Can you talk about, in an accounting sense, I guess, what are the differences that we should be taking into consideration?
I'm not sure if I'm going to the direction you want, but I'll start and you can kind of steer me in a different direction. And some of these definitely Ryan can jump in on because there's differences from a legal perspective in terms of how these operate as well. But initially, I usually contrast just because of familiarity, personal ownership of a property as compared to corporate ownership. And so on the personal side, it's to say when somebody has that property, they're going to, from a tax planning perspective, it's more counting the beans up afterwards. In other words, there's not a whole lot I can do. Whereas with the corporation, now we can have a discussion with respect to, well, should I take some income out of the corporation? Who should it go to? What form should it be? Should it be a bonus? Should it be a dividend? Should it be a short-term loan? Should I take it out now? Should I take it out later? Who should the shareholders be? I love having those types of discussions, if you will. I like having the flexibility of a corporation in the sense of, one, what I've just indicated, and two, adding to that, it's a lot easier to begin adding another shareholder to the corporation as compared to adding somebody to a deed and going through the remortgage process, etc. And so that can be helpful where you may say, hey, it'd be great if George and Ryan were involved in this project. They're going to be able to kick it up another notch and do this, do that. Let's add them in. More likely, you're going to have us involved and you're going to say, gee, it'd be a whole lot nicer if they weren't involved and get rid of them. And so it's, again, it can be easier potentially to ditch a shareholder as compared to everybody owning it personally and going through that process. So again, it's just a different flexibility side of things. On the tax side, if I have something personally, whatever my other income is and the income from the properties will dictate where my tax bracket is. And so it's a flexible thing in some cases. But if I've got a good job, for example, and I've also got some real estate, I'm probably in a relatively speaking high tax bracket. Corporations treated very differently. They're more, not that there's not a little bit that's based on income, but most of it's based on the nature of the income. And so as an example, if somebody were flipping properties or doing some rent to owns, then the majority of that income would be considered what we call active income, which is going to, on Ontario today, kind of be taxed at either 12.2% or alternatively 26.5%. And the difference being, did I or did I not make more than $500,000? If I also have some investment income going on, there's a third bracket in there that I might be subject to, which is, I'll call it 18, start rounding off the numbers, I'll call it 18%. But all of those numbers, whether we're dealing with the 12, the 18, or the 26, on the personal side, it doesn't take a whole lot before I've hit kind of a 40 or a 50% tax bracket. And so all of a sudden now that corporation can be wonderful from a tax side of things. And I'll pause there and have Ryan kind of add some comments, and then we'll tackle the family trust.
Yeah, I mean, George has really kind of explained that, and I think illustrated it, very eloquently. I mean, I can't add that much more other than say, and maybe just reaffirm that probably most of you will not, for very long, if at all, remain in like just a straight on personal ownership, structure. I mean, again, it's not to say that some of you might not, but I think most of you will, if you're doing a plan and you're talking to the right people, and you're accomplishing your goals of growth and acceleration in your real estate investments, you're going to probably have at least some component of corporate and or maybe family trust aspects in your plan. And as George has, again, like I said, really well illustrated, corporate and family trust create options. There's just a plethora of options that all of a sudden come from that. Whereas if you just own everything personally, well, there's only so many things that lawyers and accountants can do from a creativity perspective, right? To help you more efficiently grow, more efficiently accomplish, and maybe more quickly accomplish your goals, so you can set new ones and so you can have new targets, right? You know, to George's example of his executive, who that, you know, if he came, you know, to see George even back in his 60s or, you know, 50s when he was in the prime years of his wealth generation, I mean, imagine the amount of money that he could have saved on top of what George and his team were able to just do with him coming in his 80s, right? So it's that, again, I'm sort of belaboring a point here, but it's that team, it's that early connection, it's that early makeup and growing your relationship and constantly talking with your advisors that will really create an intangible value that, you know, if you're just using your lawyer or your accountant as a transaction person, then, I mean, that's fine. You know, I understand that. And we have clients and we do that all the time for those clients because that's what they would like to do. But the ones that really want to sit down and plan and get consultation and really look at where can I go with these things, that allows us to create the intangibles of really creative structure and allow the structure to grow with your changes in life. So,
do you have an example? Sorry.
I was going to kind of jump in on the family trust side of things there. Then, and so now we're ratcheting up, if you will, a little bit of the complexity, but we're also ratcheting up the options and potential tax savings. So, kind of loosely defined, I'll describe a family trust as a vehicle allowing, in a traditional example, mom and dad to control assets, control income, but they don't own anything. And so one of the benefits there, again, thinking longer term, while we may not want to talk about it a whole lot, is if I owned some properties, businesses, whatever, personally, the second of my wife and I pass away, all of those assets are deemed to have been sold for fair market value and taxes are paid. As a very, very, very rough number, 25% of my estate's going to evaporate. Whereas in the family trust, if my assets were owned under the family trust, then all of a sudden there was nothing to deem to be disposed of. Those assets are remaining now for whomever my beneficiaries are, traditionally the next generation. But again, you can mix the church, the cancer society, etc., into there. So now all of a sudden, wait a minute, 25% of my estate, that's a big number potentially, or hopefully. Maybe it's not that big of a number today, but it is something that's going to accelerate. And how large does it need to be before that's worthwhile? I mean, a $1 million portfolio, that's $250,000. I mean, to me, that's a big number. Now, Ryan and I will certainly tell people about the family trust. It doesn't mean that the family trust is created on day one. It may be something that it's part of the evolution, part of the plan. Maybe it's going to come 5-ish years from now, but there are advantages of doing it up front. Again, and the most basic is if we're able to set the family trust up before everything's getting going otherwise, then in contrast to 5 years from now we kind of shift everything over to the family trust. Well, that big shift involves an accountant and lawyer, and it involves Revenue Canada, and Revenue Canada saying, hey, you've sold everything. And in most cases, from a tax perspective, we can get around paying some of those income taxes, or all of them potentially, or at least defer them. But it involves us doing a tax selection. It can involve some business valuation information. It's certainly going to involve legal documentation. And so all of a sudden, guess who paid for all of that? And we could have avoided it had we set everything up in the first place. Again, most people won't set it all up in the first place because there's extra costs involved, etc. But I think having the discussion as early as possible then allows the investor to make the decision for what's best for them and their families.
Ryan, would you like to add to that?
No, I don't think so. I mean, again, like I said, it's George has really kind of pointed out that again, a family trust on top of a corporation or maybe instead of a corporation. I mean, it just, all of these things create options, right? That if you do your plan, options are valuable, right? Whereas if you have no options, well, you have no options, right? You just have to do what you have to do. So the more options you give yourself, hopefully the quicker you can accomplish some of your goals, so you can set new goals, and so your plan can continuously evolve and grow, all hopefully while you're saving money, which again just further adds to your pot of what you're saving, right, and so forth. I think going back to one of the points I made earlier, I guess I am answering this question. I think on the options point, corporate and trusts allow you not only kind of to accomplish like real estate aspects of what you're trying to do, but also build into it like now you're building in estate planning aspects, right? As George alluded to briefly, a trust in some ways replaces or complements, the necessities of having wills planned, right? If you didn't have a family trust, for example, but maybe you're a professional service provider, or you just have a lot of assets in corporations, you can do what are called corporate wills and personal wills, or some people call them in the industry primary, secondary wills. So these are all different techniques, and again, options, there's the word again, to hopefully give you more and more value, to give you more and more savings, so you accomplish your goals and get to new goals, hopefully in a more efficient and expeditious way, right? So again, it's that team, it's that plan, it's starting as early as you can, even though maybe that might cost a little bit more upfront. But if we're doing our job right, if Ryan and George are doing their job right, that upfront additional cost is returned within 1 year, 2 tops, and then it's just paying you back in spades after that.
Yeah, that totally makes sense. And you kind of went to a little bit to Trami. So I don't know if Trami, do you have a follow-up question, or because she was asking about the will and the trust. I don't know if she wants to jump on. Hey, Trami, I see that you're off mute. Maybe your mic's not working. Okay, we'll give her, I guess, a bit to try to fix her mic. Mm-hmm. So then I guess the next question that I was thinking that we could do was, because I know before we were talking about, how every year, things are changing. So I was wondering if you could let us know, we'll start with George, if you want to let us know in this year, especially because I'm thinking with COVID, there must have been, I don't know if that impacted the changes, but what changes have you seen that we should be taking into consideration for, our taxes?
So one of our big planning points, and kind of backing up, is to say COVID has unquestionably derailed the attention of Revenue Canada and the Department of Finance. They, as much as I may complain about them in different ways, I think they were almost heroic in the sense of trying to get out legislation very, very rapidly, trying to deal with it. Whether it was good legislation or bad, I think is a separate question. I think the effort was certainly there. And whether it should be there now or not, or what it should be, that's a separate question. But what they have done is not avoided. They just haven't had the capacity to deal with issues they would otherwise normally do. There hasn't been a federal budget this year, which again traditionally allows them to present to Canadians, here's where we're going with some new rule changes. The undercurrent, however, is to say, prior to the COVID really being launched in Canada, there was a lot of talk in the tax community and politicians with respect to whether the capital gains inclusion rate should be increased. And so the capital gains inclusion rate in English is if we sell, for example, a property or stocks, some capital asset, only half of that is taxed. The inclusion rate's 50%. Basically, the tax system prior to, and again, I'll just round about this, prior to the 70s, so the modern version of the Income Tax Act, if you will, came about effectively in 72. And from that, prior to that, there were, on capital gains, no taxes. The inclusion rate was 0. Then we went to 50%, then we went to 2/3, then we went to 3/4, then to 2/3, then to 50%. So now the question is, do we go to 2/3 or 3/4 again? And so, well, as one example, I have a client, he's been terminally diagnosed. He does not believe he's going to be here very long. And again, a decent sized estate, if you will. And so he and I, we, I guess a week or so ago, we sat down, had some beers, and of course, it's kind of he wants to get things in order for the next generation. And so then part of that dialogue is to say, well, normally as an accountant, I'm trying to defer tax and to delay it as long as possible. Whereas, well, quite honestly, maybe we should trigger it now. When that inclusion rate is lower, you don't think you're going to be living that much longer. And again, that's a delicate conversation, obviously, but it needs to be had, because if we're able to save somebody some significant funds there, he at least now he can make those decisions. And because something for him that's very important is to have a much better understanding of where he is after taxes, so that as he's dividing his assets between his kids and grandkids and charities, and I've got a pretty good idea of how he's going to do it, but he's got in his mind certain formulas that he's looking for that he just needs to see the numbers with. And so anyway, so most of our clients, of course, they're not in that type of a clear-cut situation where they know they're not going to be around very much longer. But then we turn that around to say, will I need a chunk of money in the next 2 to 3 years, for example? Well, and sorry, and by need money, I mean in the personal capacity. And maybe that's to pay off a personal mortgage, maybe that's to buy a cottage, maybe that's to do a trip to the moon, whatever it is, it really doesn't make any difference to me. But now there's some planning there to say, okay, if we think the direction of the tax increases is going one direction, up, and we see all the money that we spent in COVID, and more apparently is coming. We'll learn more about that next week too, I guess. However, there's, you pick your province or federally, for that matter, municipally and whatnot, it's hard to imagine taxes not going up at some point, or at least that's a fear many people have had, despite the assurances, at least on the federal side, that there's not an intention to increase taxes. But it also doesn't take a rocket scientist to see and read what our current finance minister, her background, her book. They're much more into the redistribution of wealth. They're not into the creation of wealth. That, again, should be telling us something. So how do we plan for that? But now it's fuzzy, because the contrary example I like to give is, it seems that for the past at least 30 years, accountants have, relatively speaking, frequently been warning people the capital gains exemption may be disappearing or changing significantly. The capital gains exemption is the ability to sell the shares of certain corporations as an individual, and today you could sell those for just over $880,000, and it's potentially tax-free. Anyway, so we've been talking about that exemption disappearing not every year, but frequently over the last 30 years. Sooner or later, we're going to be right, but our track record is exceptionally poor. So yes, maybe the inclusion rate increases, maybe general tax rates increase, but maybe they don't. So it's not that we have this, as I said, inside track into Parliament or to and whether that's federal or provincial levels. But it is something that a lot of our clients are nervous, where they're seeing how much money is going out there, most people acknowledge that's not sustainable. And they've seen the directions on the federal side of what the government tried to implement not that long ago from an estate and succession planning perspective of really significantly increasing those taxes and transitioning businesses to the next generation. So maybe we should be doing some planning with respect to that. I think there's some huge opportunities, but a relatively speaking limited window of time to use some of that. So that would be what's certainly occupying a fair bit of our time beyond the Ryan and I, for example, as I think maybe it was before we started formally here, working with the Ontario Realtors in terms of their ability on October 1st, if everything goes according to plan, to begin setting up a corporation and saving some significant taxes where up to this point in time they have not been allowed to.
Oh, that's really interesting information. That's really good to know. What about Ryan? So on the legal side for this year and like that at COVID, what changes have you seen?
Well, I mean, probably like George mentioned, I mean, a lot of the government's attention has been on just obviously helping people through these difficult times, right? So they're not focusing on a lot of some of the other initiatives that they may have already got started on and implemented or were, you know, thinking about implementing. I mean, piggybacking on what George says, it is more, it's even more important now than it's ever been to really make sure you're sitting down and having a strong plan in place, especially if you're, you know, a small business owner, like probably all of us are, right? If we're got these investment opportunities going, or if I just even use myself as an example, as an owner of a law firm, and then you know, a management and holding company, I've got to have a plan, because the benefits that existed 3 or 4 years ago, even as an example, for, you know, active and passive income splitting with, you know, spouses, all those rules have already changed and are further evolving and changing, right? So it's not to discourage people from, you know, setting up corporations and so forth, or family trusts or both, but it again hammers the point that you need to have those discussions and consultations with your advisors so that you are hopefully ahead of the curve. You're seeing the curve in the road that's about to happen again or again or again. And so you can try to align yourself ahead of time so that you can hopefully, as George alluded to, take advantage of some tax and legal structure changes. But at the same time, even if there's nothing to take advantage of, at least you can be prepared for it, so you don't get shocked and then it potentially derails you from where you want to go. But I mean, with the changes, this is why I always say it's important to start kind of with the accountant, because in the tax planning, because it really is a pillar of if you're trying to make money, which I'm pretty sure everybody on this call is, you know, what do I have to pay in tax, and is there any way to keep that as low as possible, are two huge key questions to how much you can make, right? And then, so depending on how that tax plan is set up and then evolves over time, will then impact the legal structure and the vehicles that we set up and choose for you, right? And then like just the simple illustrations that have been mentioned here, you know, active passive changes, you know, active and passive income changes, income splitting, the rules around that impact the structure and advice that George can give on a tax perspective, which then impacts us on what we set up or what we need to amend and set up. You know, it's not all doom and gloom. There's, you know, when one door closes, you know, whatever they say, another one opens, right? Or two more open, right? So the government, in my personal opinion, is usually playing a game of more catch up, even though they know all the rules and they know all the doors that can open and close. The professionals like George are typically creative to come up with new ways of, okay, you just close the door, we'll open two more, right? And so, you know, that's, again, have a good team, have a strong team of advisors, right? You know, the other example that George just gave about the change on October 1, if there's any realtors that are on the call or listening to this in the future, you need to talk to your accountant and your lawyer right away, because you can incorporate, which before that was only a privilege that brokers were allowed to have. So unless you held your brokerage license, you could not incorporate. Now you can be a salesperson and literally incorporate, which creates a tremendous opportunity of options for you for planning going forward. So, I mean, those are two really easy examples of what has already happened and what is about to happen in just, you know, 2 weeks time, that significantly impact people's tax, you know, planning, business planning, strategies for succession planning. I mean, those are big things too. I mean, if you, maybe there's people who are going to listen to this that are we've kind of concentrated on the beginning people and like early implementers, the people who are in growth mode. But there might be people that are listening to this or will listen to this that are at the other end of the spectrum. They're like, look, I've been in this for a long time. I want to hang up my shingle and leave it to the next people, or sell, or what have you. Those are important discussions to have early as possible as well, because again, the earlier the discussion is had and the earlier it's put into place with your plan, the more options your tax and your finance and your legal team can come up with, so that you can choose which one you want to use. If you leave it like the 80-year-old did in George's example, well, there's only going to be so many options that you have available. You might only have one or two. Whereas, you come see George at the beginning or as soon as possible, they start structuring things to say, okay, the capital gains, exemption, or, what's it called again, George? The one-time business exemption when you can sell your shares and stuff.
Capital gains exemption.
Yeah,
you had it right. For qualified small business corporation shares. Yeah,
exactly. So like, that's a huge succession planning tool for a business owner, which, the government knows that. They know there's a lot of money being saved there. And just like they've used other changes in the last couple of years, they're like, well, we need some money, right? Like, we just gave out all this money because COVID hit. We need to start getting some of it back. We promised the voters we're not going to increase taxes, so to speak. So let's find a way to get it so that it doesn't look like we increased tax rates, but we kind of did, because we took stuff away from people, right? So, it's going to be that kind of stuff that will be interesting to see in the months and maybe, year or next year to come, depending on how long this is all around for, in this, sort of level of intensity, on where we plan and go.
That's great information. Yeah, that's good to know. There's so many good things to know. Guys are bringing on really good information. So I think Trami is now able to, she said her mic is working, so let's try again.
Hi.
Hey, Trami.
So I know this is going to be recorded, so I don't want to make any comments about, maybe moving your assets to like some offshore, reserve or something. Anyways, so I wanted to my question was with regards to wills versus having a family trust. Like, when and why would you sort of lean towards one versus the other is more my question.
Do you want to go first, George, from a tax point of view? Like, maybe give a couple of general benefits about the trust?
Yeah, so in my mind, I expect, relatively speaking, few people would have one or the other. I think certainly I have both. I can't imagine not having both. Yes, the trust may, from a tax perspective, take away some of the importance potentially of a will, in that the trust is going to have its own set of rules, if you will, in terms of who may be allowed to receive the assets. And when, in a traditional example, the second a mom and dad passes away, well, because they didn't own anything, the will, regardless of what it says regarding some of the main assets, it won't be relevant because it'll be under, as I understand it, kind of the guise of the family trust. But from a tax perspective, there's still probably going to be the principal residence. Where do mom and dad live, assuming they're not, for example, in a nursing home or something to that effect. They, and without getting into the why to it, but they probably have what I'll call some special shares that have some value that need to be distributed as well. They're going to have all the normal household type of stuff, but from the tax side, we're probably more focused on the special shares, the house, how is that being taken care of, and then again, to me, certainly you would have both.
Yeah, I mean, I would echo the same. I mean, I think it's when you get, like, when to get a family trust is going to be, you know, a very like one-on-one conversation with your accountant, kind of on, again, where are you right now? Where do you want to go? And what are some of the options we could implement to help you get there, maybe quicker or more efficiently, with more money in your pocket? I mean, there's going to be, it's not going to be a magic number of like, you make this much money or you retain this kind of money or assets, so you bingo, you can get a trust or a corporate structure or both now. Be a little bit more of a probably fluid back and forth conversation with your planners about that. But to George's point, there'll still be important pieces in wills and powers of attorney that a family trust won't get to. A family trust is really about, well, what are the assets within the trust? So it can only govern the assets that are within a trust. So, you know, depending on what's in the trust, if you have other assets that are owned outside of it, then the will is still going to give instruction and insight around those particular assets, as well as, you know, the will's going to still give important instructions if you have children and they're minors about guardianship. It gives certainty on who you wish to be in charge of your estate from an administration standpoint, just like the trust will give certainty about this is the group of trustees or the person who is the trustee. There's still going to be potential instructions about, you know, the other assets outside of the trust that are of a personal nature. There could be specific gifts that the will still addresses. So I guess, again, going back and tying in some of the other stuff we've said earlier, your plan will have like many layers probably to it. And many of those layers all go to further wrapping themselves around you and your goals and your plan and the direction you want to go, which will have, you know, wills. You could have multiple wills, which are those primary secondaries. You'll probably have some corporate structure built in somewhere into your plan. And then for certain groups where it's applicable, that you'll start to potentially have a family trust aspect as well. You won't have all three potentially. Some people will, but you won't. It's not like, boom, you hit this level, boom, you're in this scenario, you have to have it. It's going to be a bit more one-on-one fluid planning to determine those sorts of things. I mean, you know, trusts are going to have, just like corporations, further options from like tax perspectives, tax savings, that kind of thing. But it's a, you know, it's kind of the one-on-one conversations to have with your planners. But I think it's, to George's point, it's still important to have a will and potentially a trust, you know, working together. You won't do one and then just not the other, or get rid of the other, so to speak. The other thing too, just from an estate planning perspective, this really doesn't have anything to do with the specific points of like real estate investing, but you know, with the will, you're also, you know, very wise to have powers of attorney. You know, some people call those living wills. So again, there's further documents that complement and collaborate with your corporate documents, your family trust documents, and your will. So it's just many, many layers of planning and hopeful value for you.
Did that answer your question, Trami, or you have a follow-up?
Yeah, I'm That's pretty good.
Okay, that's good. So I guess also I kind of have a follow-up to that. So for the family trust, is that done, has to be prepared before you buy the asset? Or are you able to do it like you have properties and then you're like, you know what, because of like what's been going on, I've decided like now I want to, you know, let's say start putting that into the family trust. Are you able to, how does that work?
Yeah, so from the tax side, actually, let me go back. To directly answer the question, the answer is yes, it happens in both cases. One where we'll have clients that are starting with the family trust, and that admittedly is a little bit easier because they've come and chatted with Ryan and I before the process has started. But the majority of people, they've gone off, they've bought a few properties, may or may not have a corporation, and now we're looking at ultimately transferring those properties. And often as part of this tax plan that we were speaking about initially is to say, well, perhaps we should focus initially on the next purchase and ensure that it's properly underneath the family trust, if you will, and then devise a separate plan for transferring those properties. And so one of the key things often ends up being financing issues. So in other words, if I owned a property personally or a corporation and I transfer the shares to the family trust, then in most cases, that financial institution is going to be keenly interested on who that new owner is. Certainly Revenue Canada is, as we've talked about beforehand, but now if we've got Revenue Canada at the table, we've got a bank at the table potentially, maybe we should be trying to tie this into a mortgage renewal date as an example. And so again, there may be different things that come into play as to when and how that's done. And part of it's financial. And Ryan had mentioned whether land transfer tax is going to be applicable or not. And so the cost of doing that, I mean, there are costs. And so maybe we should be kind of trying to budget that over a 5-ish year time period so that we don't get hit all at once. But other clients are going to say, no, I don't want to be thinking about this. I want it correct. Let's go. And I don't perceive that there's necessarily a right or a wrong answer. I think there are right or wrong answers for different clients. But I would suggest that I was going to say the majority, maybe that's not quite true, but pretty close if not. The majority of scenarios we see are people that are moving those family trusts to the corporations. And if I can use myself as an example, the really probably the first 25-ish years I was practicing, I'd be involved in, say, setting up 100, 200 corporations. Not that I ever did the actual articles, that's Ryan and his team, but involved from the tax side, and maybe setting up 2 family trusts. Whereas the last, I guess, since 2018, as a result of some financing changes, accumulation of a couple different tax changes, now that the family trust, maybe I'm involved in setting up 20, 30, 40 of those years. Mine was set up in 2018, and I already had a number of companies with different properties, businesses, etc. And similar to what I'm preaching right now, there's basically kind of a 5-ish year plan to move those over to the family trust. Now, admittedly, COVID got in the way of that this summer, but the theory was there anyway. But all the new acquisitions were being done through corporations owned by that family trust. So it's something that's, again, I don't think there's a only way solution. I think there are multiple acceptable alternatives. There's just pros and cons that people will weigh to see what's right for them.
Do you have anything to add on to that, Ryan?
No, definitely not. That was very inclusive.
I'm long-winded.
Well, I just realized it was 11:30. So I wanted to thank you. I feel like we could have this conversation go even longer. There's always so much to learn. But I want to thank you both for coming on. The information you provided were it was very informative, very good. I know everyone here I'm sure is also very appreciative for all the information that you guys have given us. So Ryan, do you want to give your information, your details, if anyone wants to get in contact with you?
Sure. I'll give you my website, which will have everything on it, including my cell number, but it's www.carsonlaw, carsonlaw.ca. And then my email is just Ryan, RYAN, @carsonlaw.ca. And then the office number is 905-336-8940. Yeah, so I'm happy to have people. Email is the best way to reach me. Just with during the day, it's filled with appointments, so I'm not trying to not get back to people. That's actually one of my biggest pet peeves. But email is the best way to reach me, because then I can make sure before I kind of shut down for the evening that I can get back to everybody, at least to say, hey, I got your email. It's going to take a day or two to respond properly, or I'll just respond in that day to the questions that somebody's asked, right? But yeah, I'd be more than happy to chat with anybody anytime over the phone or via email about what you might be up to, whether it's personal, whether it's professional, whether it's both, and where you're trying to go with your real estate endeavors. So thanks for having us on, Diana, and Trammy. It was nice to get your questions. I know that we'll probably have some more follow-up in the weeks to come.
100%. Thank you. And George, so if you'd like to provide your information.
Sure. So on my side, probably email is the easiest way to get a hold of me. So Gdube, Gdube, at bdo.ca. I do also have a blog that has some other information, etc. to it, and I've put it in the chat there. But for those that can't see that, it is again www.bdoreinvestor.ca. And similar to Ryan, greatly appreciate the opportunity. And actually, I guess it was Ryan that kind of got me involved here. So again, thank you both for that chance, and look forward to chatting with whomever. I admittedly am probably not quite as good with email as Ryan. I, similar to him, tend to be in meetings all day. And it's not that I don't work hard, but I have a bit of volume there, so I do have a person, my admin person, that helps out with that. So at times it might be just a touch longer, but it's not that we're trying to ignore anybody by any means.
Yeah, and I mean, if I could just add a selfish plug here, Diana, I mean, we alluded to it. If there are any realtors on the call, or if you know any realtors, or anybody watches this video in the future here, definitely touch base with your accountant lawyer team about the possibilities of incorporating. This is just a huge planning opportunity for people that are real estate agents that hold their license, that have been prohibited from using incorporations, to help them give themselves options for planning. October 1, we're expecting big things, and I think it's a great opportunity for realtors that have been kind of stifled for many, many years. So this is a great opportunity. So if you are one, or friends and family that are them, or other investors and colleagues, and they're not aware of it, put them in touch with us, and we'll give them as much information and as help as we possibly can.
Yeah, thank you so much, guys. And I know that we all appreciate all the information you guys had provided. So thank you so much. And it was really nice having you both on. And hopefully in the future, we'll do some more.
We'll have a follow-up.
Absolutely,
Awesome.
for sure.
Thank you
Thank
so
you, everybody.
much.
Bye.
Bye, everyone.